Welcome back to the deep dive.
Glad to be here.
Today, we are grabbing a stack of source material that focuses on one of the most common yet most intimidating tasks in modern life, moving money.
And moving it now.
Exactly, moving it with urgency.
That's right. We often treat bank processes as these, magical black boxes,
Okay.
especially when time is tight.
For sure.
Our sources today center on a real-world dialogue. It's between a customer and a bank teller about an urgent money transfer.
And the stakes are high. It's to pay a critical overdue bill.
Very high.
So the mission for this deep dive is to transform that fear of banking jargon into confident expertise. We're not just going to be defining terms, we're extracting the foundational vocabulary, the procedures, and maybe the surprising technical architecture that you need to master the scenario.
Right. We want you to walk away actually feeling like you get it, truly well-informed.
The urgency of this whole scenario is really our engine today. A customer needs to transfer funds immediately to a company account.
And they are terrified. You can just feel it in the dialogue that the bill is already overdue.
And that feeling, that pressure, it drives every specific question, every procedural step, and every technical detail we're about to analyze.
We really need to understand the stakes involved.
So let's jump straight into the mechanism itself. I mean, when we say we're moving money, what does that actually mean in the 21st century?
Well, we have to start with the verb at the heart of this entire process, which is to transfer.
Okay.
In its simplest form, the word just means to move something from one place to another. We transfer schools, we transfer boxes from the attic.
Right, you transfer a file on your computer. Simple.
Simple. And the source material highlights that keeping that simplicity in mind is key to understanding the action. But when we apply it to banking,
It gets complicated fast.
it becomes instantly technical. We are moving money, or more accurately, the numerical value of money, from one bank or one account to another.
So the movement is still there, but the medium has completely changed.
Completely. And this is where we have to introduce the specific mechanism mentioned in the dialogue, the wire transfer.
Okay, so wire transfer. It's not just another way of saying transfer.
It is not a synonym, no. The term wire transfer tells us how the money is moving. It specifically means that the transfer is entirely electronic.
Why is that distinction so important? I mean, isn't everything electronic now?
Well, yes and no. It sets this type of transaction apart from, say, writing a check, which has to be physically processed, or even a slower, batch-processed electronic transaction like ACH.
Okay, so what's a fundamental practical difference between an electronic wire transfer and, I don't know, handing over cash?
The critical insight, and this is the thing that often surprises people, is that no physical currency moves. Not a single dollar bill.
Really? None at all.
Not in that moment. The moment you initiate a wire transfer, you are initiating a highly secure, immediate communication of information between two financial institutions.
So it's like a message.
A very powerful message. Bank A is telling Bank B, we have reduced the number in account X by $5,000, and you must now increase the number in account Y by $5,000.
And the actual dollar bills, they just stay in the vaults. Or I guess as digital entries on some massive ledger.
They do. They stay right where they are. It's a commitment of funds, a promise backed by heavy regulation. And this leads to the first really high-stakes difference that you, our listener, need to understand. And that is the concept of irrevocability.
Irrevocability, so you can't take it back.
Exactly. When you initiate a true wire transfer, unlike, say, a personal check that might bounce or a credit card charge that can be disputed and reversed months later, a wire transfer is typically irreversible.
Wow.
Once that instruction is sent and verified by the system, that money is legally committed to the recipient. It's gone from your control.
So the stakes are immediately raised. The customer in our dialogue, she needs this urgency to pay an overdue bill, and the bank is providing that urgent commitment.
Right.
But this irreversible nature is why banks require so much identification and precise paperwork, which I'm sure we'll get into.
Absolutely.
Because if that number, that value, goes to the wrong person, it's just gone.
It is exceptionally difficult and very often impossible to retrieve. That's the core tension. The speed and the certainty are its chief benefits, especially when a bill is overdue. But that irrevocability, that is its greatest risk.
The whole modern economy really relies on that immediate trust, doesn't it? That trust inherent in the electronic communication.
We have to trust that the bank is making good on its promise and making good on it instantly.
Okay, so when we're talking about this numerical value that's moving, we're almost always using the term funds.
Funds.
It's a word that's just ubiquitous in banking, and we probably need to clarify its usage.
Yeah, it's a good point. In a banking context, funds, always pluralized with an "as," is just a more formal, more specific word for money.
So if you're transferring money, you're transferring funds.
Pretty much. It sounds simple, but using the correct terminology, it just signals a certain level of sophistication. It shows the language.
But the source material also pointed out a common and slightly confusing verbal usage of the root word, the singular verb to fund.
Yes, and this is where the word shifts from a passive quantity, which is money, to an active purpose, which is paying. To fund something means to actively pay for it,
It's about providing the resources.
often providing the initial or even the total amount necessary for a big expenditure or a project.
And this provides a great aha moment of language comprehension. The example we found was perfect. My grandfather funded my college education.
Right. He didn't just passively give you money for books one day.
Yeah.
He actively provided the financial resources necessary to make that entire education possible.
So you can transfer funds to fund a project. The language is all connected.
It is. And all of these actions, transferring, funding, committing, informing, they are all wrapped up in this overarching noun that describes the entire event, the transaction.
A transaction. It's the defined business deal or move, which in a financial context almost always involves the exchange of some kind of monetary value. It's the big umbrella term.
Exactly. A wire transfer is a specific high-speed type of transaction.
But as the material reminds us, the scope of a transaction is much wider.
Much wider. Cashing a check is a transaction.
Yeah.
Depositing money into your checking account, that's a transaction. Withdrawing cash from the ATM.
Another transaction.
All of them are distinct types of transactions because they change the status or the location or the ownership of the funds within the banking system.
So if you're buying an expensive piece of equipment for your business, the entire process, handing over the funds and receiving the equipment, that whole thing is the transaction.
Yes. Yeah.
And the wire transfer or the check or the debit card swipe, that's just the instrument you use to settle the money part of that bigger deal.
Precisely. And understanding the transaction as a binding financial event is crucial, especially when we talk about fraud and that irrevocability we just discussed.
Right, because the wire transfer ensures that the monetary element of the transaction is settled immediately and definitively.
It is, which sets the stage perfectly for where those funds are coming from and, more importantly, where they are going.
Okay, so to execute any transaction, especially an irreversible wire transfer, we need to locate the funds.
And they reside in an account. This is the registered space for money held by an individual or a company. It's the basic unit of all banking.
And what we found highlighted the distinction between the two most common types of personal accounts. They serve very different functions.
And sometimes the rules governing them can affect the speed or even the cost of a transfer.
So first, you have the savings account.
The savings account. It's designed specifically to store money for the long term. You're not supposed to be touching it all the time.
Right.
So these accounts often have restrictions, maybe on withdrawal frequency, or they require a minimum balance precisely to encourage that active saving. They're generally not designed for the day-to-day flux of rapid transfers.
And then there's the other one, the checking account. This is the operational hub. Sometimes it's called the default account.
That's right. Money goes in, but it's intended to be taken out, often almost immediately, for expenses, paying bills, going to the movies.
Or initiating that urgent wire transfer.
Exactly. This is the account where the high-stakes transaction in our dialogue is almost certainly originating.
And the differences aren't just trivial, are they?
Not at all. I mean, think about it. If the client needed the funds transferred urgently and all her money was sitting in a savings account that only allows, say, 3 withdrawals a month.
And she's already made 3.
She's already made 3. The bank might need to perform an internal transfer first from savings to checking, which adds a slight complication and maybe a small delay to the overall procedure.
Okay, so once we identify the account the funds are leaving, we need the precise destination. And this is where most people get tripped up. You can't just write Bank of America, Joe Smith. We need the unique, precise coordinates for that electronic transfer, the bank routing number.
This number is the DNA of the electronic money transfer. Without it, the transfer simply cannot be directed correctly. It's a long, multi-digit sequence that identifies the specific financial institution.
But why does it need to be so long and specific? I mean, couldn't we just use the bank's street address?
Because the transfer is happening in an instant, digitally, across these massive national, or even global networks. Think about two different banks named First National Bank.
There are probably dozens of them.
There could be one in 20 different states. The routing number has to distinguish between the specific bank location, the specific legal entity, and sometimes even the specific type of account it's going to. Is it a business account or a personal account?
It ensures surgical precision.
That's the goal.
Now, here's where we can really elevate the knowledge for our well-informed listener. In the United States, this routing number has a specific industry name, right?
It does. What we all commonly call the bank routing number is formally known in the U.S. as the ABA Routing Transit Number, or RTN, from the American Bankers Association, which issues them. It is always 9 digits long, and those 9 digits are structured to identify the Federal Reserve District where the bank is located and the bank itself.
That's critical for any domestic transfer routed through U.S. clearing systems like Fedwire or ACH.
Correct. That immediately connects that simple 9-digit number to the massive infrastructure that's running the entire U.S. economy.
But the urgency of our scenario and the need for global applications, it forces us to look beyond just the ABA number. What if our client was trying to pay a vendor in, say, another country?
Then the complexity multiplies.
Yeah.
And we have to introduce international identifiers because the ABA number is totally useless internationally.
Okay.
Globally, you'll need 2 additional crucial identifiers. First, the SWIFT code. It's often also called the BIC, which stands for Bank Identifier Code.
Okay, so what's the function of SWIFT?
SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication.
That's a mouthful.
It is. But it's the global messaging network that banks use to send these transfer instructions. The SWIFT, or BIC code, is typically 8 or 11 characters long, and it identifies the recipient bank anywhere in the world.
So it's like the address for the bank itself.
A perfect analogy. It tells Bank A in New York, I need to talk to this specific branch of HSBC in London. It's the address for the bank on the global network.
That makes perfect sense. So the SWIFT code identifies the bank, but how do we identify the specific account within that bank?
Oh, that's where the second international identifier comes in. The IBAN.
IBAN.
The International Bank Account Number. This is a sequence of letters and numbers. It can be up to 34 characters long, which is used primarily in Europe and many other parts of the world.
And the IBAN isn't just a random string of numbers.
Not at all. It's highly structured. It contains the country code, the bank code, and the specific account number, all standardized into one long format.
So let's recap this for our listener because it's so important. If you are sending a domestic wire transfer in the U.S., you need the 9-digit ABA routing number.
And the account number.
And the account number. But if you are sending an international wire transfer,
you will need the SWIFT or BIC code for the bank and likely the IBAN for the specific account.
And you cannot skip these. You can't guess them.
Absolutely not, especially when you're dealing with the high-stakes, irreversible nature of a wire transfer.
And this brings us right back to our source scenario. The client was prepared. She had all the necessary materials.
Which means she had the correct routing information for the company she was paying, and that preparation is the essential first step to meeting her urgent deadline.
The urgency of this whole situation is driven by a single purpose. The client needs to transfer funds to a company account to pay a bill.
And the term "to pay a bill," it means to legally cancel the amount of debt owed to a vendor, whether it's for electricity or rent or telephone services.
The fact that the money is going specifically to a company account signals that this is a definitive debt settlement. It's not a gift.
Right. And increasingly, especially for larger companies, electronic banking, like the wire transfer, is the standard mechanism for high-value or time-sensitive bill payment.
The stakes here are so tangible. You're trying to avoid service cutoffs or late fees or, damage to your credit rating.
Which leads us directly to the core pressure point in the dialogue, the fear that the payment is overdue.
We define overdue as simply being late, missing the expected or required time. But the word due itself needs a little clarification. The date a bill is due is the absolute deadline. It's the date by which the required action, the payment, must be completed.
So if the electricity bill was due on Wednesday and the client rushes into the bank on Thursday, that payment is officially overdue.
Which means penalties are probably already accruing. Or worse, the service cutoff process has already started.
The clock is ticking loudly.
I do love how this word translates outside of finance, though. The source gives that wonderful example of visiting a relative.
Oh.
If you haven't seen your grandmother in months, that visit is long overdue.
It is. It shows that the concept of missing a deadline, a required time frame, applies just as much to our social obligations as it does to our financial ones.
And it carries that same sense of pressure and, the need for remediation.
It does. And the urgency of an overdue payment connects right back to the technical architecture we just discussed.
How so?
Well, if the client needs the payment to count today, right now, they choose a wire transfer over, say, an ACH transfer.
Right, which might take 3 to 5 business days to clear.
But here's a key point. Even the wire transfer isn't instant cash appearing in their account.
Yeah.
And this brings us to the critical, yet often misunderstood concepts of clearing and settlement.
Okay, let's dive into that technical reality. If a wire transfer is supposed to be immediate, what exactly are clearing and settlement, and how do they affect that overdue bill?
Okay, so a true wire transfer, one that's routed through a real-time gross settlement system like the U.S. FedWire, it is indeed immediate in the sense that the bank sends the irreversible instruction within minutes. That part, the communication of the transfer instruction, that is the clearing process.
So the company receiving the money knows the instruction has been sent instantly. They get the message.
Precisely. The funds are legally committed, and the receiving company's bank will usually credit their account instantly, allowing them to act on that money. But settlement is the second background process. Settlement is the final, definitive exchange of assets or cash between the two financial institutions, between Bank A and Bank B.
So clearing is the promise and settlement is the delivery. Is that a good way to think about it?
That's a perfect way to think about it. For a domestic wire transfer, the settlement happens either immediately or very, very quickly behind the scenes.
But the point is, because the wire transfer mechanism is so fast and its instruction is irreversible,
the company receiving the payment can immediately mark the client's bill as paid.
Even if the final interbank settlement hasn't technically occurred yet.
Even then.
Yes. That makes the urgency solvable. The irreversible, instantaneous communication of the wire transfer ensures that the client meets the deadline in time to stop those penalties.
It provides that crucial relief.
It does. It's the whole reason the teller can say with confidence, we can process it today. The technical process actually supports the emotional need.
So now that we understand the urgency, which is the overdue bill, and the action, the irreversible wire transfer, we have to discuss the structured path to completion. And that is the procedure.
Right, the procedure. It's defined as a series of actions, steps, or a fixed process required to complete a task.
And in a bank setting, this isn't a suggestion, it's a strict requirement.
It's designed for security and compliance.
Absolutely. The procedure for a wire transfer involves very specific steps, like filling out forms, verifying your identity, and providing all those essential routing numbers we talked about.
And this structured nature is what protects everyone involved.
It guarantees that this irreversible action is based on verified consent and on accurate information.
We can contrast this with procedures in other high-stakes fields. The source mentioned a medical procedure.
Right. A medical procedure is also a fixed series of steps that have to be followed precisely to achieve a therapeutic outcome. If a surgeon misses a step in heart surgery, the consequences are disastrous.
And the consequences of missing a step in a wire transfer procedure, like mistyping one digit in that routing number, can also be financially disastrous.
And that links right back to that concept of irrevocability.
Yeah.
And that's why the language used by the teller in the dialogue is so critical. He says, I will take you through the procedure.
That phrase is so central to the customer service aspect of this. It's the bank teller's active promise of guidance.
It is.
It means the teller is going to serve as the expert guide, ensuring the customer understands and follows every mandatory step correctly, getting the ID checked, ensuring the routing number matches the account name.
And signing the commitment form. The teller is essentially performing a compliance function.
A compliance function? What do you mean?
They're ensuring that the bank meets its own internal rules, but also legal regulations, particularly those related to anti-money laundering and know your customer, or KYC requirements.
So when the teller says they will take you through, they're not just being helpful, they're ensuring the legal and regulatory integrity of this irreversible transaction.
They are.
It's like if I were helping a younger relative open their first savings account, I would say, let me take you through the procedure, explaining they need their ID, proof of address, and a starting deposit. It's all about navigating complexity.
And this brings us to the moment of success in our source dialogue. The prepared client.
Yes.
The material highlighted that the customer came prepared with all the necessary materials in a folder.
And this preparation is the ultimate efficiency hack for banking. It really is.
It is. The necessary materials that were listed, the company name, the precise bank routing number, whether that's an ABA or a SWIFT IBAN, the bank's address, and a phone number. These are mandatory checks against fraud and error.
So if a client just walks in without the correct routing number,
The procedure stops immediately. The transaction cannot be executed, and the bill remains overdue.
but because this client was prepared, the bank teller could immediately confirm, we can go ahead and make the transfer right now.
That speed confirms the immense value of preparation. In a high-stakes, urgent scenario, having that folder ready transforms a potential crisis into a swift, simple transaction that gets processed the same day.
So the procedure, when you follow it correctly, it actually becomes the solution to the urgency.
It does. And focusing on that required information is our opportunity to address the breakdown of trust. You asked earlier, if the routing number is so precise, why does fraud still happen?
Yes, exactly. If the system is designed for surgical precision, where is the vulnerability?
The vulnerability often lies in the instructions that are given to the client before they even get to the bank. The bank's procedure is rigid and secure. The weak point is usually the customer being tricked into providing the wrong routing information. This usually happens through a sophisticated phishing scam or what's known as business email compromise, or BEC.
Business email compromise. What's that?
The scammer compromises a vendor's email account. Then they send the client new wire instructions, a new routing number, a new account, to divert the funds to their own fraudulent account.
Oh, wow. So the bank teller follows the procedure perfectly,
Perfect.
but they're following the wrong instructions that were provided by the client, and the client was operating under the assumption that they were talking to the real vendor.
That's it. And because the wire transfer is irreversible, the client loses the funds.
That is the tragedy of BEC fraud.
It is. And it just underscores why the procedure is so stringent and why you, our listener, should always double-check these critical numbers. Use a second non-electronic communication method, like a phone call, especially when paying large sums,
The procedure is the guardian of the funds.
but only if the inputs are honest.
Understanding this entire procedure and all this vocabulary, it isn't just useful for a rushed trip to your local branch. It has vast, daily, global applications for your personal finance and for business.
Absolutely. Think about the need for remittances. People sending money home while they're living or working abroad.
Right.
Knowing the distinction between a cheap, slow money transfer and a fast, expensive wire transfer is crucial for managing your budget and your family's needs.
We brought up the international identifiers earlier, the SWIFT and the IBAN, and this is where that technical knowledge becomes immediately practical.
Yes.
So if you are living in the United States and your parents in Spain need to send you funds, you need to understand that they can't use your ABA routing number.
It won't work. They will need the SWIFT or BIC code for your U.S. bank to route the instruction correctly to the institution.
And then my specific account number.
And then your specific account number.
Yeah.
And conversely, if you are sending money to a vendor in Germany, you will almost certainly require their lengthy standardized IBAN, that comprehensive account identifier.
So you now have the vocabulary to discuss receiving those funds confidently. You can tell your parents, please ensure you have the correct SWIFT code, or tell your boss, I received the funds that were wired from Spain.
That simple knowledge transforms a really complicated process into a manageable exchange.
And this need for rapid, secure money movement, it extends beyond formal banks.
The source material introduced the important alternative service, Western Union.
Western Union.
It's perhaps the most famous non-bank service for people to transfer money. It's known globally for its widespread availability.
Especially in areas that might have limited traditional banking access.
Right.
The mechanism they use is fundamentally a type of wire transfer. Funds are wired electronically from one Western Union location to another.
And the recipient doesn't even necessarily need a bank account.
Correct. They can just pick up the cash at their destination. They'll have been wired the numerical value from the sender's location using a control number for security.
It just reinforces that the concept of wiring money, that rapid electronic transmission of information about monetary value, it's a distinct method of moving money. It doesn't matter if a huge corporate bank or a small neighborhood kiosk facilitates it. And this leads us to the final, and I think perhaps the most fascinating point that was raised in the source material.
And what's that?
The origin of wire transfers and the deep speculation about its history.
Yes. The very name, wire transfer, suggests a technology that predates fiber optics and digital banking systems.
It does. The speculation in the material connects the term directly to the older technology of the telegraph.
The telegraph. So a series of dots and dashes sent over a physical wire.
The telegraph was the first major system to rapidly communicate information over vast distances using electrical wires. Before widespread use of phones or computers, the fastest way to communicate anything urgent was via telegram.
Including that a quantity of money had been deposited at one location for pickup at another.
Exactly.
So it begs this historical question. Did the specialized money-moving services, the precursors to Western Union, did they create the initial system for rapid financial communication using the existing wire infrastructure of the telegraph?
Before the formal banking system adopted it and formalized it with things like the ABA number and FedWire,
Yeah.
it's highly likely. Early institutions needed to send funds across the vast distances of the United States. And the established telegraph lines provided the only viable, fast network.
So the banks needed to quickly inform their distant branches that a credit needed to be applied.
And the infrastructure of rapid communication, the wire, it had to exist first, before the irreversible commitment of funds could be implemented reliably across different institutions.
So the very name wire transfer is a historical artifact. It's a linguistic echo of the first time humanity figured out how to move information, and by extension, financial value, faster than a person on horseback or train could travel.
It connects that high-tech immediate action we discussed in Section 1, that instantaneous electronic FedWire, right back to its simple 19th century ancestor.
A clerk just tapping out a sequence of dots and dashes to commit $500 across the country.
And the urgency was the same then as it is for our client in the bank today. Hashtag tag outro.
Wow. So we've taken a seemingly simple, urgent trip to the bank and transformed it into a deep understanding of, well, global financial architecture.
We moved far beyond just basic definitions today. We established that a wire transfer is an inherently irreversible electronic transaction.
Where you're moving the numerical funds, not the cash itself.
And the procedure is rigid precisely because that commitment is immediate.
We dove into the critical, almost life or death importance of the bank routing number, distinguishing between the domestic ABA number and the international SWIFT and IBAN structure.
These are the unique identifiers that prevent fraud and ensure that surgical precision.
And we connected the client's very real fear of being overdue directly to the technical process of clearing and settlement.
Explaining how the instantaneous instruction of the wire transfer immediately resolves that time pressure.
So by understanding this language and the procedural steps, you're now equipped to navigate not just your local bank, but international finance.
You know the technical names, you know the stakes of irrevocability, and you know the global tools necessary to move money quickly and securely.
We've unpacked the how and the what of modern transfers, but we want to leave you with that final piece of historical curiosity.
The source material raised this fascinating question. Is the wire transfer an evolution of bank systems, or did the very idea of moving value over the wire, the telegraph line, precede and dictate how banks would eventually structure their own immediate, high-speed transactions?
The history of digital currency literally started with physical wires. Consider that initial leap it took to move money digitally for the very first time. It's something to explore further.
Maybe over a wire transfer receipt.
Until next time, keep digging deeper into the concepts that shape your world.